You're watching Magnetic Media News Network. I'm Mia Kudos. This is Behind the Headlines, because what matters isn't only what happened, it's what happens next. Let's begin. This week, the financial world turned its attention to the Federal Reserve as it signaled a potential shift in its monetary policy stance. For the first time in over a year, the Fed hinted at a possible pause in its aggressive interest rate hikes, citing emerging signs of cooling inflation. However, this pause isn't a done deal. The Fed emphasized that its decisions will remain data-dependent, particularly as wage growth and service sector inflation remain stubbornly high. Markets reacted swiftly, with equities rallying on the prospect of cheaper borrowing costs, while bond yields fluctuated as investors recalibrated their expectations. So, what does this mean? The Fed's signal suggests a delicate balancing act. On one hand, policymakers are wary of over-tightening and triggering an unnecessary economic slowdown. On the other, they remain committed to ensuring inflation is firmly under control before declaring victory. For businesses and consumers, this could mean a temporary reprieve from rising borrowing costs, but it also introduces a new layer of uncertainty. If inflation proves stickier than anticipated, the Fed may resume its hikes, leaving markets in a state of limbo. The ramifications of this shift are far-reaching. First, emerging markets could see a resurgence in capital inflows as investors seek higher yields in riskier assets, now that the dollar's strength may stabilize. Second, the housing market, which has been battered by high mortgage rates, could experience a modest rebound if borrowing costs ease. However, this rebound hinges on the Fed's ability to navigate the narrow path between inflation control and economic growth. A misstep could reignite volatility, particularly in sectors sensitive to interest rate movements, such as technology and real estate. What should we watch next? Keep a close eye on two key signals. First, the upcoming jobs report. Strong employment data could reignite fears of wage-driven inflation, pushing the Fed to adopt a more hawkish tone. Second, the next consumer price index release. If inflation remains elevated, markets may price in a higher likelihood of further rate hikes, dampening the recent optimism. Additionally, monitor corporate earnings, particularly in interest rate-sensitive sectors, to gauge how businesses are adapting to this uncertain environment. So, what is the smart money doing? Smart money, neutral. While some investors are positioning for a Fed pivot, others remain cautious, waiting for clearer signs that inflation is truly under control. That is what sits behind today's headlines. Thank you for joining us for Behind the Headlines. Until next time, stay informed, stay ahead. And if you haven't already, subscribe for more intelligent analysis, Monday to Friday.